The indicators that investors use to measure the health of the U.S. stock markets have taken a turn for the worse, fueling worries that the benchmark index may revisit its mid-June bear market low. The S&P 500 is down 7% since mid-August following a sharp summer rally, battered by expectations that the Federal Reserve will raise rates higher than previously anticipated in its fight to bring down consumer prices from their 40-year highs. Asian stocks and U.S. equity futures advanced on Friday as investors assess whether monetary tightening to tackle inflation in the U.S. and Europe is getting closer to being priced in. Equities rose in Japan and Australia in the wake of modest Wall Street gains that left the S&P 500 above 4,000 for the first time since late August. Shares in Hong Kong rebounded on shorts, covering ahead of a long weekend in China. And staying in the Asia region, the Bank of Japan Governor Haruhiko Kuroda says rapid yen moves were undesirable after a meeting with Prime Minister Fumio Kishida on Friday. He joins a chorus of policymakers warning over the currency's recent sharp drop to 24-year lows. Kuroda said sharp currency moves are undesirable as they destabilize corporate business plans and heighten uncertainty. Germany is ready to implement a minimum corporate tax through national laws if the European Union cannot reach an agreement. The country's finance minister has said this, even as his French counterparts hinted at potentially doing the same. Hungary has raised objections that have held up the EU's adoption of a 15% minimum corporate tax, hampering a deal that would have turned a global plan into law across the bloc. Crude oil prices rose on Friday as investors considered Russia's threat to halt oil and gas exports to some buyers. Crude is set for a second weekly decline as central banks' aggressive rate hikes and China's COVID-19 curbs weighed on demand. Brent crude futures rose to $89.37 a barrel, while U.S. WTI crude futures climbed to $83.64. We're going to take a very quick time out. When we come back, we are in East Africa, where a recent scandal involving one of the country's power sector players has landed the CEO on suspension, as well as members of the management team for fake surveys, running into almost 500 billion shillings worth. We'll have the details after this. We're having some technical difficulties with our guest from Kenya, but in the meantime, just to give you a bit of a background on what is now turning into a very, very big corruption and fraud scandal. Now, an internal audit of the Rural Electrification and Energy Corporation revealed a startling irregularity. It showed that the Kenyan state-owned corporation had paid at least 430 million shillings for geospatial land studies and for business consultants. So why is that irregular? Because those projects were never carried out. Now, as a result of this, the Rural Electricity Provider's CEO, Peter Mbugua, has been suspended, and its accounting and finance staff has also been shown the door. And unfortunately, the company has been plagued by incidents like this for a number of years. And when you look at the situation, it's just one more in a conversation where many Kenyans and possibly Africans across the continent are asking, what do state-owned entities really do for them? There's the questions around the fake surveys, checks and balances that should have been in place, and who should have been monitoring these approved surveys as it would have been. Now, the Rural Electrification and Energy Corporation, unfortunately, as I said, has a long history of irregular corporate governance, malpractice, and even corruption. In 2019, the company was accused of awarding a contract to supply wooden poles to 5 companies who shared the same board of directors. It said that this was a lapse of judgment that led to the supply of substandard wooden poles, which the company ended up paying for. And this is something that really should have been discovered during the due diligence that is typically carried out before a contract is awarded. Now, local media has also referenced an internal audit that was dated July 2022, which showed that the CEO prepared irregular payment invoices together with payment certificates of surveys for projects that did not exist. These came to around 430 million shillings. And one of the suspension letters is what gives the details of all of this. So questions are being asked right now in the Kenyan press and by Kenyans. Where are the checks and balances? Where is the due diligence that needs to be done? Who is responsible for signing this? And if the CEO's signatures are on these fake surveys and fake payments personally, what will happen to him? The biggest question many are asking is what happens next? Is he going to be maybe prosecuted and sent to jail? And what happens to the recovery of this money? Another big question that is happening now is, were these firms fake firms that were simply set up in order to take advantage of this lapse, or were they actually real firms who could have been in on the fraud with the rural electrification company? So as I said earlier, the CEO has been suspended as well as members of management. Many want to know what happens next. Almost 500 billion shillings for fake surveys. Now, finally on this, before we go on a quick break, the Competition Authority launched an investigation in 2019 that saw those 5 companies I talked about earlier sharing the same board of directors, and it fined them. And the probe began after a complaint from a whistleblower. So there's also the conversation around how whistleblowers can also help in improving accountability, particularly for public and state-owned companies. And many will be also asking if there will be a change in policy to help prevent these kind of things from happening again. So we just wanted to give you a quick background on this major story happening in Kenya. You'll probably see it's around the business news. The CEO of the Rural Electrification and Energy Corporation being suspended, being involved in apparently paying for fake surveys by geospatial engineers and business consultants. As updates for this story come about, we'll bring them to you. We're going to take a very short break. When we come back, we get into Stock Market Watch for this week. My guest is standing by. That's guarantee. The equities and fixed income markets in Africa's largest economy has been taking some bashing in recent days, but that sentiment may have changed just a bit on Thursday with improved outcome for most bond offerings. The NGX did end the day bullish, and that's the first time this week. Joining me to break down the Naira and Kobo of this story is Victor Aluyi. He's the Senior Vice President and Head of Investments for Sankore Global Investments. Victor, welcome again to the show. Thank you for joining me this morning. So it's been a really interesting week. We are in the final day of the week, but we are talking this as a watch, not necessarily a roundup, but I will get a prediction from you in a little bit. But Treasury bills market was largely quiet. There was minimal activity seen across the board. Leading up to Thursday, what was going on?
Well, I think the market, particularly if you look at the fixed income markets, largely been driven by liquidity. And liquidity has remained really, really tight. For the rest of the year, really, we expect that liquidity would remain really, really paltry. We will have the bulk of the liquidity for the year coming in during the first half of the year. So for the remainder of the year, really very tight liquidity situation. So for this week, I think market direction typically would largely be dictated by, the outcome of the primary market auction. So there was a treasury bill auction midweek, where, the central bank sold about 214 billion worth of notes on the 91-day, the 182-day, and a 364-day paper. Suffice it and very instructive to point out that we saw increases on the stock rates across board. So the 91-day paper essentially closed at 5.5%. That's 1.5% higher than the previous auction. The 180-day paper closed at 5.85. That was 0.85% or 85 basis points higher than the previous auction. And on the one-year paper, we saw that close at 10%, which was about 1.5% higher than the previous auction. Clearly, the last time we saw one-year treasury bill rates at about 10% was a little over a year ago. So typically, when you have significant upward revisions, at the primary market auction, it typically spirals or feeds through into the secondary market. But we didn't quite see that yesterday, and that's basically on the back of the fact that really very, very tight liquidity in the market. We saw a maturity that came through yesterday. However, very, very paltry and really couldn't move the needle in terms of market move. So we really expect that sentiment from the auction will probably filter through to the market today as liquidity gets even tighter. But certainly for the remainder of this week and going into next week, that move that we saw at the primary market auction would basically anchor expectations, at least in the near term.
So when you look at how much higher some of the bonds sold, the 91-day, the 180-day paper, it gives you an idea that there's still a bit of interest and a bit of attractiveness with Nigerian Treasury bonds. But would you call it an outright success? Even as you said that we haven't seen such a good report or a good outcome in about a year. But does that show us that there's still something there for investors with what Nigeria is offering?
Well, the truth of the matter is that at these levels, they don't seem greatly attractive, right? We have inflation at almost 20%. We have the policy or benchmark policy rate, that's the monetary policy rate, at 14%. Real return, really, if you look at that one-year paper and you compare it to inflation, deeply in negative territory. So it's not greatly attractive, but we've seen significant improvements over the last couple of months. And really, the expectation is that, that is likely to continue. Obviously, the monetary authorities will certainly want to try and control, the interest service burden, that the government will have to take, because obviously the higher the rates, the more interest that the government will have to pay. But the reality of the macro conditions and the monetary variables essentially dictate that these rates should be higher, and there's certainly more room to go in terms of making it much more attractive for the average investor, either retail or institutional.
Okay, so if we're talking about Nigeria's T-bills, then I have to ask about Nigeria's Eurobond. How does that, where does that stand now? How attractive is it, or maybe not so attractive at this point in time?
Well, truth of the matter is that there are quite a number of variables that control what happens in that market. A good number of them really out of our control. All of the interest rate hikes that we're seeing globally, particularly in the US, for instance, certainly has an impact on our on our Euro bonds, from a pricing perspective, from that, risk perspective as well. However, just to, give a bit of a context around how Euro bonds have behaved over the last couple of weeks, we've seen, strong volatility. As a matter of fact, if you look at the various points of the curve, the short end to the medium and to the long end of the curve, yields are higher if you compare to where they were at the beginning of August, for instance. Yields still are higher. However, if you look at what we've seen this month, we've seen a retracement in yields lower, but we've sort of seen a recovery this week where yields have gone, have dropped, this week really, on the back of, just some technicals really. People looking at these yields at these levels average about 13 thereabouts, and they seem really attractive to investors. But I think there's probably still some volatility ahead, particularly with respect to what the US Federal Reserve does, and the impact that will certainly have on not just Nigerian Eurobonds, but the entire emerging markets, and particularly sub-Saharan African Eurobonds. So they look really attractive now, could become more attractive in the near to medium term.
Okay, so let's also look at the fact that the NGX has even admitted the listing of the Lagos Free Zone, the LFZ's 25 billion naira 20-year 13.25% infrastructure bond on its platform. It's early days, the interest, what are you hearing in terms of how interested people are in this? What do you think will bring the interest about as well?
I mean, the interest will essentially come about as a result of, attractive yields. So if you look at that, that's essentially a corporate bond. Again, from a return perspective, if you compare to the sort of variables that we've got now, doesn't exactly look great. But it is essentially priced off of the sovereign curve. So it's understandable that, it's trading at those levels. Again, being a corporate bond, it certainly serves to provide some sort of diversification within the portfolio. From a duration perspective, maybe a couple of questions there. 20 years out is quite long, for a corporate entity. But I think that, within, the pension fund managers, there would certainly be some sort of appetite, for that instrument. And I think its listing on the NGX essentially just provides a platform where there is certainly greater liquidity, particularly in the secondary market. I mean, we found over the years that, corporate bonds typically have a lot less liquidity, but I think that this listing should, help elevate the level of liquidity that would have in that particular instrument.
All right, Victor, before I let you go, finally, Thursday gave us a bit of a bullish run, maybe not a run, but maybe just at least one step for the week. Where do you think the rest of the steps for this week will be, especially ending today and then possibly how we might open on Monday?
Well, I mean, I think that the week is likely to still end sort of weak, particularly in the treasury bills market, just on the back of the really tight liquidity situation. I expect we'll probably have a CRR debit today. Again, I think that the secondary market will certainly want to start to reflect, the results of that primary auction that we had midweek. So I think that the market is likely to close a touch softer today. How we open on Monday will really depend a lot on, what happens over the weekend in terms of news and all that stuff. But again, I think that we are on course to stay, softer going into next week.
All right, Victor Aluyi, I'm going to get it right, and I've gotten it right. Aluyi, thank you so much for joining me today. We'll see you again next week.
Thanks for having me.
All right, thank you very much. And it's an interesting place where you find the Nigerian exchange operating in currently right now. There are a number of things happening in that regard. But of course, the bullish end coming on Thursday, one more day to full trading, and which has, of course, already kicked off. And in the next few hours, we'll know what things will definitively look like for the NGX at the end of this week. You're watching Business Edge. The end of this week for us comes with NC4 to watch. Stick around. And now to a few stories we're using to wrap things up. We start in North Africa, where Egypt has received a Ukrainian wheat shipment of 63,000 tons contracted before the start of the war between Ukraine and Russia. The condition attached to this was that the Russian supplier would bear responsibility for the shipment and safe delivery of the cargo. Tunisia's dinar has fallen to new record lows versus the dollar. The central bank data is showing that a decline is threatening to erode Tunisia's foreign currency reserves and could make debt servicing more expensive, as well as widen the budget deficit. The number of Kenyans out of work has doubled despite over a decade of infrastructure-fueled economic growth and faster adoption of technology. This has left East Africa's largest economy with the highest unemployment rate in the region. The World Bank data shows that 5.7% of Kenya's labor force was out of work in 2021, up from 2.8% when the Jubilee administration took over in 2013. And finally, back in West Africa, the 2021 Auditor General's report has expressed worry about the general decline in the returns of the Ghana Petroleum Fund's investments from about $17.5 million in 2020 to around $14.19 million in 2021. The report recommends that the investment mix for both the Ghana Stabilization Fund and the Ghana Heritage Fund should be reviewed for possible maximization of the return for those investments. And that ends a week of African business, the economy, and finance happening right here on Business Edge. Don't forget to follow us on social media. We are at News Central TV. Download our mobile app, subscribe to our YouTube channel, and of course, watch us on all the platforms we are available. You can catch us on DSTV channel 422, Star Times channel 274, as well as Avo TV. I'm Tolulope Adeleru-Balogun. Have a restful weekend, because on Monday, we work to make that money and to make the week profitable.